Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Stephen English of Blankstone Sington. Hello, Stephen.
Hi, Alex.
First, could you just tell me a little bit about Blankstone Sington?
Sure. Well, we're a traditional stockbroker originally, founded 1976, so been around a while. And from that, we've morphed into more of an investment manager, private client broker, discretionary fund manager now. But stock picking is very much in our DNA. Fully resourced house. We do our own back office settlements as well.
So you're here today to talk about your AIM ISA and AIM ISA portfolio, your ISA portfolio. Tell me about it. What's its aim, and what can it do for investors?
The aim is there's a lot of solutions, products out there at the moment. It's an accelerated way to get out some inheritance from your estate after 2 years by investing in AIM companies. But we feel that we do it very differently to others. This has been a long time in the making. We've got a strong track record, and we do go where others perhaps can't due to our size and our boutique type nature. Okay,
because I was going to ask you why you well placed compared with others to do this.
The AIM has a infamous reputation, and that's probably well deserved. There was a lot of companies that really shouldn't have listed. It doesn't reflect well on the advisors, on some advisors anyway. But Blankstone Sington as a house, we make no apologies for being cautiously postured. Our wider DFM solution is regularly first quartile in terms of volatility. We've just been shortlisted for an award on that. And from that conservative approach, I've taken that over to the AIM side and adapted it slightly. So what is a high risk area, we are trying to sanitize the risk as far as possible. Conservatism is our ethos, and we put that forward to the AIM strategy.
So what sort of companies then are you looking to invest in?
Ideally, those that are growing at a structural level rather than cyclical. They have a strong niche. If we were American, the phrase "there's riches in the niches" would work better, but we can't say niches, so niches, but there absolutely is. So often, even if the wider sector that they're operating in is shrinking, because their market caps are so small and they have this insurgent attitude and they are for their clients, they can take market share off the incumbent. So that's structural growth, or they just do something better, or they've got a new product or service or very strong IP that takes market share from the bigger companies.
So perhaps you could provide me with a few examples of these type of companies.
Sure. We'll start with the first one. They were both recent additions, recent IPOs in April this year. Alpha FX. These design and execute foreign exchange hedging strategies for companies that are perhaps too small to be able to do it themselves. This was a firm founded in 2010, and speaking to the management team over the phone, you got the sense of the founder-led culture was excellent. Management still retain a 50% stake in the business. It's hugely cash generative. It's not that cyclical at all. And when we speak about market cap, their market cap of what is a £450 billion industry, foreign exchange hedging, their market cap is less than 1%. There's net cash on the balance sheet. They came to AIM because they were capital constrained. They needed to raise £11 million. Their market cap at IPO was £60 million, but because management owned 50%, effectively it was a £30 million market cap. And that precluded a lot of bigger operators from getting involved in what is a really strong story. The sales are growing 30% per annum. Their pre-tax margin is 50%, 50%. There's very, very few companies you will see a pre-tax margin that high. Strong structural growth. They just do it better than the banks are offering the service at the moment. Wonderful company.
Okay. And what about some other companies people might have heard of?
Another company, again, it was a IPO in April, K3 Capital. This is a firm out of Bolton, so not too far away from our office in Liverpool. These are disrupting the corporate finance market. Essentially, they're kind of a matchmaker. If you want to sell your business, they will find the right buyer for your business. They operate in the niche between £50,000 value business up to £50 million, and that's underrepresented. Their market share, the figures are quite hard to get, but it's less than 1%. Now again, management still retain a 50% stake in the company. It's hugely cash generative. The payout ratio is 80%, so the yield at IPO was nearly 8%. Reason for that is a lot of investors, it was too small for them. The market cap was £40 million. Because management owned 50%, the investable market cap was essentially £20 million. So the broker had to bring it to market at a very, very cheap price. It's up 60% since then. It still yields 5.5%. There's net cash on the balance sheet, but it's just a wonderful business model. Matchmaking buyers and sellers, they take transaction fees, but they also take non-contingent fees. So the non-contingent fee element actually pays all the fixed costs, so they're profitable without having to sell a business. When they do sell a business and get the commission or transaction fee in, that's all drops through to the bottom line, hence why you've got such a high dividend yield. Only on a PE now, still 13 times, still a lot of growth to go after.
And are there any sort of companies in your portfolio that people are likely to have heard of, sort of household names, bigger companies?
The bigger companies that they've probably bought the product and maybe they don't even realise. A tissue manufacturer out of Blackburn called Acrol. They listed taking market share of the likes of Andrex. A lot of people aren't aware now, but post-Brexit with the foreign exchange movements, there's around 30% less toilet tissues in an Andrex roll, whereas these are maintaining the amount. They work with Aldi and Lidl. They're growing 10 to 15%. And in fact, if you want a super luxurious tissue, you can only get it from Lidl because these are the only manufacturers who bring the tissue in to make it. But they make the tissue at the same quality as Andrex, but just at a big price discount. And we believe they are on the cusp now of breaking into the likes of Sainsbury's, Asda and Tesco.
Most of your competitors, the other companies we're dealing with, typically the average market cap of the company they're dealing with is maybe 400, 500 million. I understand what you offer, you're looking generally at smaller companies, is that correct?
That's right. And when a fund manager comes into us, we always ask, what is your natural capacity? Every strategy's got a natural capacity. The investable universe isn't infinite, so we always ask that. No more is that more pertinent than in the small cap arena. So to maintain performance integrity, we will cap the strategy in our AIM IHT service around 150 to 180 million pounds. We believe, and our clients would expect us to pick the best companies from a risk reward perspective, irrespective of their market size. So just because something's 600 million pounds doesn't mean that it's better or growing strongly. Often tomorrow's winners are going to be in the 50 to 100 million pound cohort. So if your market cap, and we're seeing some valuation extremes at the higher end of the market, maybe we'll come on to that in a second, but the stronger risk reward we're seeing in the 50 to 100 million pounds. And if you look at the construction of AIM, nearly 80% of AIM companies are 100 million pounds or below. So if you're excluding any or precluding any investment into that, you're almost trying to fight with two arms tied behind your back. Whereas for us, we think that the best returns for our clients are where we have the biggest investable universe.
But does it also mean when there's the next stock market crash, which of course there will be at some time, are your stocks likely to crash more than, say, in some of the larger AIM portfolios?
There's an argument for both ways. Very good question, tricky question, thank you. What I would say is, to get to 150 to 180, our average market cap is around 150. That means us taking about a 3% position. But more than that, investors should look at what is the absolute pounds invested in that company. I would argue if we're trying to exit a £1 or £2 million ticket, that will be a lot easier, even though the stock is 100 or 150 million pounds, than something, and you look at one investor, they've got a 55 million pound stake in a 600 million pound company. Now, you can only sell that to an institution. The problem is, if that price is not conducive to their risk reward, who are you going to sell that 55 million pound stake to? I worry that the larger cap stocks, once you start to build these big stakes, are akin to a Chinese finger trap. Easy to get into, very, very hard to get out of.
So bubble territory in a lot of these sort of big IHT stocks?
Yeah, the bubble word. I'm concerned. I am seeing certain parallels with the Nifty 50 of the late 60s. Just as a brief recap, so there was no defined list of 50 stocks, but roughly some of the best companies in the US got bid up to ludicrously high levels. The average PEs were 2 or 3 times the S&P at the time. The S&P was trading around 19 times. Some of these stocks, which include the likes of IBM, Coca-Cola, McDonald's, Xerox, Kodak, Polaroid, so they weren't all good companies eventually. Disney was in there as well. Some of them were bid up to 40, 50, 60 times earnings. And the problem is there's no company that is so good that can't turn into a bad investment if you pay too high a price for it.
Very true.
Back in the 60s, people forgot that. At 73, it peaked, and that cohort of stock went on to underperform for years and years and years. They fell by more than the market in the bear market of the 70s. So for us, our overriding mantra is that risk is primarily a function of price. If you overpay on day one, your future returns arguably going to be a lot lower, if not negative. But 2, you're taking a lot more risk than if you pay below the intrinsic value of the business.
Before we wrap up, I'm going to try and encourage my parents to invest in an AIM ISA this tax year. Why should they choose you?
We feel that we've had the track record. We've been doing this since 2010. For what it's worth, for those that look at volatility, we've had lower volatility than the FTSE 100, and we've had lower drawdowns even than the FTSE 100. We looked at the fee schedules from our peers, and we thought that some of the fees were pretty egregious. We think that you deserve, as an investor, a great service at a great price, and we are easily first quartile from a value point of view. But I would point to, this is in our DNA. This is an extension of what we've been doing for 40 years. We have institutional rigour without the straitjacket. We can go where our larger peers can't anymore. They're precluded because of their size. ISAs are fantastic for AIM because they are such strongly growing companies. Very often, we've got clients now who've made 200,000, 300,000, 400,000 pounds of capital gains. If that was not in an ISA, you're having to pay then 20% away, and it just really starts to add up and negates the whole essence of what you're trying to do, which is to avoid your 40% inheritance tax. So come to us, Alex, and because I like you, because I know you, we'll give you an extra special deal.
Well, that's great. Thank you very much, Stephen English and Blankstone Sington.
Thanks, Alex.
Thank you.